Let me say one thing that is probably going to piss a lot of people off. After years of trading, indicators, strategies, models, market profiles, algorithms, I realized price only does one thing. It moves between imbalances and equilibrium. And once you truly understand where that imbalance is, you don't need 15 indicators, you don't need a complicated strategy, you don't even need multiple setups. You need one box. In this video, I'm going to break down the only supply and demand framework that I personally use, how I define it, and most importantly, what I wait for as confirmation before I ever touch the buy or sell button. And if you stay until the end, you'll understand why most traders mark zones that look right but have zero real order flow behind them. So if you find value, make sure to smash that like button, but also make sure to hit that subscribe button. I have over 1,500 videos on this channel teaching you on how to trade for completely free. And then also, if you haven't already, make sure to join the free Discord that I have, where I live trade, send out setups, and answer any questions that you guys have about trading. That link will be down in the description, but let's hop into it. Now, I want to start off with why most people fail with supply and demand. And here's the problem. Everyone knows what supply and demand is. Almost nobody understands how it actually forms. Most traders are taught this. If there's a big green candle on the move up, you mark the bottom. If there's a big red candle down, you mark the top and wait for price to come back. That's not supply and demand. That's visual pattern recognition, not auction theory. Real supply and demand comes from unresolved institutional activity, areas where price moves faster than the market could fairly transact. And when price leaves an area too quickly, it leaves behind unfinished business. And that unfinished business is the entire reason the market comes back. Now, here's the core concept. The one box strategy is simple in structure but deep in logic. Instead of drawing multiple zones, ranges, and levels, I focus on one single area of interest, the origin of displacement. That's it. The box is defined by where price went from balanced to imbalanced, not the entire range, not the wick, not the high or low. Just the last area where both buyers and sellers were active before one side lost control. And that box represents liquidity being absorbed, orders being stacked, and failed auction process. This is where institutions entered, not where retail reacted. And here is the checklist. If an area doesn't meet all of these, I ignore it. 1, there needs to be compression before expansion. And I'm going to be plotting these zones, that way you guys know exactly what to look for. But again, there needs to be compression before expansion. Price must show tight, overlapping candles before the move, and that tells me that price or the market was in equilibrium. If there's no compression, then there's no box. 2, there needs to be displacement. I want to see an aggressive expansion away from the area, meaning large candles, minimum pullbacks, and I want to see clear structure broken. And that is critical. Displacement tells me one side was forced to reprice. And then 3rd, inefficiency. The move away must leave clean, fast price action. Why? Because fast moves create inefficient transactions, meaning price did not fairly trade in that area. Markets hate inefficiency. They come back to clean it up, and that's the entire edge that I'm going to teach you. So let's go ahead, let's plot some zones, and then I'll break down the rules that you want to look for before you take a trade based off of the one box system. Okay, so going based off of the rules that we just talked about, we are looking for compression within the market before a large and expansive move away. So the easiest way to start identifying supply and demand zones is first looking for a big move within the market. So I'm looking for big moves up and I'm looking for big moves down. So if we go ahead and we look on over here on the 1 hour time frame on the S&P futures, we can see that we had a large and aggressive move down right here. Then once we identify the large and aggressive move down, we then want to look one candle to the left. That one candle to the left has to be the opposite color. So if it's a large and aggressive move down, well, when we look one candle to the left, this wants to be a green candle or whatever color you have that represents the green candle. In this example, mine is blue, but I'm gonna go ahead and just call it green. This will be a green candle and this will be a red candle. So very large and aggressive move down, red candle here. Look, one candle to the left has to be the opposite color. So this needs to be a small green candle. Now, when it comes to the term small green candle, it's kind of subjective to how big it is that red candle. Like this green candle could have came all the way down to here and I would still mark it. But if it came all the way down to here, well, then that's not a small green candle. in correspondence to the red candle. So again, it's subjective. But then all we are going to do is we are going to take our one box and we are going to plot it from the bottom of that green candle to the top of that green candle. And we are going to go ahead and we are going to project this to the right. Now, this is going to be our supply zone. This is where unfilled institutional sell orders are sitting within the market. So what we are waiting for to happen is for price to return back up into this area, and then we are going to start looking for rejections. Now, with this supply zone, I will mark the bottom of that wick, the open of that wick, and then the high of that wick. These are going to be our reference points when looking for rejects. Typically, the highest probability areas that we will find that price rejects off of is going to be that bottom wick, the open of the candle. Those are the two highest probabilities, and then there is a lower probability that will reject off the upper wick. So this would be considered a good supply zone. And as you see, price came up, rejected off of it there, rejected off of that there, and then ended up rolling over. Same thing over here. Big move down, look one candle to the left. What are we looking for? A small green candle. Same thing over here, big move down, look one candle to the left, small green candle. So again, we are going to take our box and we are going to plot it from the bottom of that green candle to the top of the green candle and then project it to the right. As we can see, rejected off the zone there and we ended up going down. We made a new supply zone right here. So we're going to take our box, we're going to plot it to the upper wick. In this scenario is going to be that upper red candle wick. If that's higher than the green candle wick, then you'll just mark it there. And again, you can see that we did have some price rejection off of it right here. So that is how you are going to mark supply zones. As far as demand zones, it's going to be the same thing, but flipped upside down. We want to look for large and aggressive moves up. Look one candle to the left, has to be a small red candle in this scenario. Again, the small red is subjective to how big the green candle is. We're going to take our one box. We're going to plot it from the high of that red candle to the bottom of that red candle, and then we're going to project it to the right. Now, what we're going to do is we are going to change this to green because this is where unfilled institutional buy orders are sitting within the market. And again, we're going to plot the upper wick, we're going to plot the open of the red wick, and then we're going to mark the bottom of that red candle. Now, again, these are going to be our reference points if price were to come back down into this area to look for a potential bounce. Our highest probability is going to be that upper wick as well as the open. And look at what happened. As soon as we touched it the first time, the S&P went from about 68.32 up into like 68.50. So that's about an 18-point move to the upside that you could have caught based off of this strategy. And then let's go ahead and look at one more example over here. Big move up, small red candle to the left. What do? Take our one box. We're going to plot it from the upper wick to the bottom wick, and then we're going to project it to the right. And as you can see, we had some price action off of this level in the pre-market session. So that is how you are going to plot these zones. Now, here's one thing that you want to keep in mind when price approaches the zone, because this is where most traders get smoked. Price returns to the box and they blindly enter. And what happens 9 times out of 10 if you blindly enter? You get stopped out. Why? Because supply and demand is not a level. It is a process. The first return tells you nothing. Institutions don't defend zones emotionally, they defend them conditionally. So you want to always wait for confirmation when we hit these zones. And this is the part that separates pros from amateurs. When price enters my box, I am watching for 3 things in order. First is going to be deceleration. Price must slow down. If price enters the zone fast and leaves the zone fast, there was no interaction. If there's no interaction, then there's no trade. Second, I'm looking for internal structure shift. Inside the box, I want to see failed continuation, lower highs in supply, higher lows in demand. This tells me the opposing side is losing control. And then third is going to be redisplacement. Only after structure shifts do I want to see another impulsive move. The second displacement confirms orders are still active, the zone is still valid, and smart money defended the level. That is my entry trigger, not the zone, the reaction to the zone. So the point that I am trying to make, you always want to see a reaction when we hit these supplier demand zones. If there's no reaction, you do not take the trade. If there is a reaction, then you take the trade and your stop loss is right on the opposite side of that confirmation candle. Now, this all works because it's based on market mechanics. Supply and demand, it exists on 5-minute time frames, 30-minute time frames, daily time frames. When it comes to how I personally plot it though, I will plot these zones on the 30-minute time frame the 45-minute time frame, the hour, 2-hour, 3-hour, 4-hour time frames, as well as daily, weekly, and monthly timeframes. But I promise you, if you guys join my live trading sessions and you watch me trade this strategy live, you will see how accurate these zones are. So the time frame, it technically doesn't matter. I would just say personally stay above the 30-minute time frame, but 5-minute time frames do work when using supply and demand. What really matters though is the behavior to the zone. So if you understand imbalance, inefficiency, and confirmation, you're trading logic and not patterns. Now, the reason why I will trade this strategy forever, the markets evolve, indicators fail, strategies stop working, and I've been trading for 8 years and I've had strategies that just do not work anymore. But auction dynamics will never change. There will always be buyers, there will always be sellers, and moments where one side is forced to reprice. As long as institutions need liquidity, supply and demand will exist. That's why I don't need multiple strategies. I need one box and patience to wait for confirmation. So if you want to go deeper into how I mark these zones live, how I pair this with order flow, and how I manage risk around the box, make sure you're subscribed. Make sure you tap into my live trading sessions. I go live for Asia, and I also go live every single morning, 15 minutes before New York market open, because this is the foundation of everything that I trade. But if you guys did find value in today's video, make sure to smash that like button, as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Everybody have an amazing rest of your day. I'll see you guys in the next video.